Chapter 3 deals with understanding your income. A big part of understanding the income is the paycheck and the deductions from that paycheck. You had a video recently concerning that. So right now we're going to look ahead for a moment. Once you eventually start that career you're dreaming of, maybe after college or maybe after some other post-secondary education, along with that career will come a regular paycheck. You may get paid weekly, every 2 weeks, once a month, but the fact is you'll be earning regular pay. Hopefully that paycheck is not the only reason you choose a career, but we will leave that discussion for another day. Let's take a look at more detail regarding that paycheck. As you saw in the video recently, the typical paycheck for full-time workers, often even for part-time student employees, has one amount for gross pay and another smaller amount for net pay, or what is often called take-home pay. The difference, or the deductions from gross pay, can be a number of different things. But one of the most common things that all employees see on their paychecks are deductions for taxes, including federal taxes, state taxes, and local taxes. So we're going to start there. It's important for you to know a bit about those taxes and how they are collected from the employees, not only locally, but all around the country. I want to go into more detail, particularly about the federal taxes that are deducted from your paycheck. On your screen, you see something called tax tables for the year 2016. If your parents prepare their own income taxes, they are probably very familiar with this form. We're going to look at that in a moment. First, a bit on what all this means. The money raised by federal income taxes helps to run our country. It's collected by law from employees based on their annual income. The money is used for any number of things: national defense, infrastructure, building highways, providing for many of the services that the federal government provides for citizens of our country. As I said, it's collected from employees, and it's collected by law. It's not an optional thing. And you might also know, as I said before, if your parents are currently preparing their taxes, we are now in what we call tax season, which means employees around the country need to prepare and then file their taxes by April 15th of 2017. The process works like this. Based on their yearly earnings, now we're talking here about 2016, the calendar year from January through December 2016. Based on those earnings, employees will be required to pay anywhere from around 10% to over 20% of their money, all the money they earn, for federal income taxes. So how do you know how much you'll have to pay? Well, the Internal Revenue Service that makes forms like this one on your screen, and the part of the federal government that is responsible for collecting taxes, will tell you. They'll tell you. They publish tax tables that will tell you how much income tax you're going to have to pay based on how much you make. We're going to stop here and take a look at what this tax table actually looks like. On your screen, you'll see, as I said, a tax table for this past year. Now, if we scroll down, you will see that there are page after page after page that looks something like this. Now, these numbers are pretty small. You may have to squint just a bit, but it will tell you that if your income it talks about line 43. There's a form that gets you to this point. We're going to keep it very simple and just look at this for right now. Basically, what it means is that if you look at uh, this number right there, you will see that a person who makes $1,000 a year, between 1,000 and 1,025 actually, will have to pay $101 for federal income tax. Well, that's not too much, $101. But the fact is, if you earn $1,000 for the entire year and you're a full-time employee responsible for living on your own, you could be in a bit of trouble. Now, what you see is that $101 is based on the heading of the column. And the heading of the column here says single. So if you're single, that's what you pay. If you're married, you could file jointly or you could file separately. And we're not going to get into the difference right now, but there's a different amount that you pay sometimes if you are married or single. And head of household, again, is something we're not going to get into this point. It gets things much too complicated for our purposes right now. But let's look at a more, hopefully, realistic situation. Let's assume you have graduated from college, you've gotten very good grades, and you've landed a great job, and your starting pay is $70,000 a year. Wow, wouldn't that sound good? So 70,000 a year. Let's go down. We're going to have to go down a number of pages. Bear with me as we scroll down, and you can see all these numbers and columns page after page based on what people might be making for the year. Let's say that you're going to make $70,000. Or let's change this. I'm sorry. We're going to make 72,000 because that's what I have highlighted. So take a look at that. So you started now with a salary, an annual salary of $72,000 a year. Okay. Now, if you made that much money in 2016, from January through December of 2016, this table tells you, if you look at the highlighted number there, if you can read that, if you made between $72,000 and $72,050, you owe $13,778 in federal income tax. Now that's a chunk. It's a little bit more than our first example with earning only $1,000. So you're going to earn 72,000, but the bad news is you have to pay almost 14,000 of it to the federal government. Now, that doesn't even include the state taxes. You also have to pay state taxes. There may be local taxes that you have to pay. So that is pretty significant. The reason I'm showing you all of this right now is because you need to understand how your payroll deductions work. The federal government doesn't want to wait till April 15th each year to get that $14,000 that you're going to pay, almost that much for federal income tax. They like to have your money sooner than that. So they also understand, and most people realize, that not everyone saves as they should be saving. So what you think you ought to be doing here probably is to save a bit of money each week so that by the time April 15th comes around, you've got that money in the bank so you can pay the government. Well, a lot of people don't do that. A lot of people, unfortunately, don't save as they should. So what the federal government says is, number one, we want your money as soon as we can get it, number one. And number two, we understand that maybe we need to force you to save. So that payroll deduction is, in a sense, a forced savings account. So each month, or each week, or each bi-week, when you get paid, you're going to see a deduction. So in theory, you'll get enough deducted from your paycheck each week so that by the end of 2016, by the end of the calendar year, you would have paid what you owe. You've paid everything. Now, it's not quite that simple. It doesn't always work that way. It is more complicated than that. And perhaps there are ways that you can lower that $13,778 that you owe. We're going to be talking about those kinds of things later. One example, quickly, is that you could give money to your high school that you graduated from. That is a tax deductible contribution. So if you gave $1,000 to your Catholic high school, and that is called a charitable deduction, same way if you gave money to the Red Cross or any other charitable deduction, um, you can reduce that $13,778. So that's the good news. That's why people do often think or talk about tax deductible contributions. So that can be reduced, but we're not going to get into that much detail right now. What I want you to realize is that the federal income tax is a deduction from each of your paycheck, and the amount is based on what you're going to be earning. And in theory, by the end of the year, you will have paid at least most of the taxes that you owe. There may be sometimes a situation where an employee finds that they've had deductions from their paychecks that don't add up quite to the amount that they owe. That's why they have to pay by April 15th. They have to pay the difference. So if you've had deductions from your paycheck from your $72,000 that added up to only $12,000, that means you're going to have to pay a little over $1,000 by April 15th of 2017 to get the money to the government. So this is just one quick look at the federal income tax. If we look at the state income tax deduction, that works in a very similar way. The state of Ohio also has tax tables like this that will tell you based on the amount of money that you earn during the year, you'll have to pay X amount of dollars. And it's going to be deducted on a regular basis from your paycheck. And at the end of the year, you're going to have to file Ohio state income taxes as well. So if you talk to your parents or some other adult, they can tell you what a headache that can be to get all that cleared up. Many times people end up hiring somebody to do their taxes for them to prepare that information, and that is why we have companies like H&R Block in business. They do taxes. Obviously, they charge a fee for that as well. So that's the end of this particular lesson. At this point, I'll ask you to go on to your course page for your next assignment. Thank you.